In 1609, the merchants of Amsterdam built something that had never existed before, a bank so secure, so trustworthy, so perfectly designed that it became the envy of the world. For nearly 2 centuries, it was the safest place on earth to store wealth. Kings deposited there. Empires traded through it. The entire global economy ran on its promises. Its reputation was built on a simple, unbreakable rule. Every guilder deposited would be backed by real metal in the vault, 100% reserves. No exceptions, no tricks. But in 1790, when French revolutionary forces threatened the city, officials opened the vault to prepare for evacuation, and they discovered something that shattered 2 centuries of trust. The gold wasn't there. Most of it had been gone for decades. The world's most trusted bank had been operating on a magnificent lie. And no one, not the merchants, not the nations, not even most of the bank's own directors, had known. This is the story of the first great illusion. To understand what the Bank of Amsterdam became, you must first understand what Amsterdam was. The financial capital of the 17th century world, a city built on trade, credit, and trust. But by 1600, Amsterdam faced a crisis. Dozens of different coins circulated through the city. Spanish reals, Portuguese cruzados, German thalers, all with varying degrees of wear, clipping, and debasement. No one knew what anything was truly worth. Trade was grinding to a halt because every transaction required negotiation about the quality of money itself. The city needed a solution, something that could standardize value and restore trust to commerce. In 1609, the city council created the Amsterdam's Whistle Bank, the Exchange Bank. Its mandate was revolutionary. It would accept all the world's currencies, assay their true metal content, and issue standardized account credits backed by real reserves held in its vault. It was elegant, it was logical, and most importantly, it was public, owned and operated by the city itself, not private financiers. This wasn't someone's scheme. It was Amsterdam's sacred promise to the world, and for generations, that promise held. The Bank of Amsterdam didn't lend money. It didn't speculate. It didn't engage in risky ventures. It did exactly one thing. It stored metal and kept records. When a merchant deposited coins, the bank would say them, test their purity and weight, and credit the merchant's account with bank guilders representing the true metal value. These bank guilders could then be transferred between accounts to settle debts. The system was brilliant in its simplicity. Instead of physically moving coins around the city, risking theft, where in endless disputes about value, merchants could simply transfer credits on the bank's books. It was faster, safer, more efficient, but the true genius was the rule. The bank promised it would always maintain 100% reserves. Every bank guilder in circulation was backed by actual metal sitting in the vault. Always, no exceptions. This was unprecedented. Most banks and money changers operated on trust and reputation, but their actual reserves were secret. The Bank of Amsterdam made its reserve policy explicit and absolute, and it worked spectacularly. Within decades, the bank guilder became the most trusted currency in Europe. Merchants preferred to actual coins because it was standardized, reliable, and couldn't be clipped or counterfeited. International trade increasingly settled in Amsterdam bank credits. The bank became so essential that in 1683, Amsterdam required all bills of exchange above 600 guilders to be settled through the bank. It wasn't optional anymore. It was infrastructure. It was the foundation of the global economy. And that trust created something subtle, something dangerous. Because the bank held deposits for so many merchants, the actual demand for withdrawals was predictable. On any given day, some people would deposit and others would withdraw, but the amounts largely balanced out, which meant something tempting. Most of the gold just sat there, unused, dormant, and sitting unused were also the city's debts and ambitions. Amsterdam was fighting wars, building infrastructure, funding the Dutch East India Company's expeditions. All of these required capital. And there, sitting in the bank's vault, was an enormous pool of idle capital. The temptation was obvious. What if the city quietly borrowed some of that idle gold, just temporarily, just for essential purposes? It would be returned, of course, And since the gold was just sitting there anyway, and withdrawals were predictable, who would know? It was logical. It was practical. It was a beginning of illusion. Sometime in the late 17th century, the exact date is unclear, which itself is revealing, the city began borrowing from the bank's reserves. Not all of it, just some, enough to fund operations, enough to matter. The ledger still showed 100% reserves. The public still believed, but the vault had become hollow. Here's what made the deception work. It wasn't immediately harmful. The city borrowed gold from the reserves, yes, but it used that gold for arguably legitimate purposes. Defending the republic, building trade infrastructure, things that, in theory, increased Amsterdam's prosperity and therefore the bank's own security. And more importantly, the system kept functioning. Merchants deposited and withdrew as always. Credits were transferred. Trade flourished. The bank's reputation remained unblemished. Because here's the secret of fractional reserves. They work perfectly well until they don't. As long as depositors don't all demand their money simultaneously, a bank can operate with far less reserves than its ledgers claim. The gold serves not as a functional necessity, but as a psychological anchor, a promise that calms nerves and maintains trust. The Bank of Amsterdam had discovered what modern banks know intimately. Money is more about confidence than metal. Over the decades, the gap between claimed reserves and actual reserves grew. By the mid-18th century, the bank claimed to hold perhaps 20 to 30 million guilders in reserve. The reality was closer to 10 million, but the system adapted. The directors, the few who knew the truth, managed the situation carefully. They regulated withdrawals subtly. They ensured the vault never faced sudden mass demands. They maintained the illusion through careful administration. And remarkably, it worked for generations. The merchants trading through the bank never knew. The international traders settling accounts in bank guilders never knew. Even most of the bank's own employees never knew. The secret was kept by a tiny circle at the top, and they convinced themselves they were protecting the system, not betraying it. After all, the bank still functioned. Trust remained intact. Commerce prospered. Where was the harm? This is how institutions decay. Not through sudden corruption, but through incremental compromises that each seem reasonable in isolation. Borrow a little from reserves. Just this once. For good reasons. Then borrow a little more. Because the first borrowing worked fine. Then make it standard practice. Because it's been working for years. Then forget it was ever supposed to be temporary. Because everyone who remembers is dead, and the new generation inherits the system as they find it, never questioning whether it matches the original promise. By the late 1780s, the Bank of Amsterdam had been operating on fractional reserves for nearly a century. The discrepancy was enormous. The deception was institutional. But the reputation remained perfect because no one had ever tested the promise. No crisis had ever forced a mass withdrawal. The vault's actual contents remained theoretical, a question that didn't need answering because trust was sufficient, until 1794. In January 1795, French revolutionary armies invaded the Netherlands. The Dutch Republic, weakened by internal divisions and external pressure, collapsed. Amsterdam faced occupation. The city's leaders, anticipating evacuation or siege, made a decision. They would inspect the Bank of Amsterdam's vault to determine what could be saved or moved. It was a routine precaution, an administrative necessity. It became a historic revelation. The officials opened the vault expecting to find the legendary reserves that had backed the bank's reputation for 186 years. They found instead a hollow shell. Where millions of guilders in gold and silver should have sat, there were only scattered remnants. The bulk had been lent to the Dutch East India Company, the city government, and other entities, much of it never to be repaid. The vault was perhaps 1/3 full at most. The most trusted bank in history had been operating on reserves that would have collapsed at the first serious test. The discovery was kept quiet at first, but in the chaos of occupation and regime change, the secret leaked. Documents surfaced. The truth spread. The bank that had defined trustworthiness had been a lie for generations. Merchants who had believed their wealth was safe discovered it had been secretly lent away. International traders who had settled accounts in bank guilders realized the currency's backing was fictional. Nations that had trusted Amsterdam with their reserves understood they'd been deceived. But here's the strange part. Nothing immediately collapsed. The French occupation transformed the bank anyway, restructuring it into a new institution. The old promises became irrelevant. The system was rebuilt on new terms. And because the crisis came wrapped in war and revolution, the bank's deception was lost in larger catastrophes. The revelation that should have destroyed trust in banking itself was buried under the noise of regime change. This was almost fortunate, because if the world had fully processed what the revelation meant, that the most trusted institution in financial history had been operating on a lie for a century, it might have destroyed trust in banking itself. Instead, the lesson was learned quietly, privately, by the people who mattered. The banking establishment across Europe studied what happened, and they learned not that fractional reserves were dangerous, but that they were inevitable. If even the Bank of Amsterdam, with its explicit promises, its public ownership, its sacred reputation, couldn't maintain full reserves, then full reserves were clearly impossible. The question shifted from should banks maintain full reserves to how can banks manage fractional reserves without getting caught? Amsterdam's mistake wasn't a deception, it was getting discovered. And that lesson, that the system works as long as no one checks, that confidence matters more than reality, that a beautiful lie can sustain itself for generations, that lesson was absorbed deeply. The Bank of Amsterdam's exposure should have ended fractional reserve banking. Instead, it normalized it, because once the secret was out, once everyone in the financial world understood that even the most trusted institution had operated this way, fractional reserves stopped being a shameful deception and became accepted practice. If Amsterdam did it, Amsterdam, with its centuries of reputation, its public ownership, its explicit promises, then clearly this was just how banking worked. The 19th century saw the explosion of modern banking, and nearly every bank operated on fractional reserves, but now openly, or at least less secretly, the Bank of England, the Banque de France, the emerging American banks. All of them lent out more than they held in deposits. All of them created money through credit expansion. All of them depended on the same principle Amsterdam had discovered. Most people won't withdraw their money simultaneously, so full reserves are unnecessary, but they added safeguards. They created reserve requirements, not 100%, but some percentage that regulators decided was safe. They developed central banks that could serve as lenders of last resort. They built elaborate systems to prevent bank runs. All of this was designed around a central truth that Amsterdam had revealed. Banking inherently involves promising to pay more than you can actually pay at any given moment. The entire modern financial system is built on this controlled impossibility. When you deposit money in a bank today, you believe it's sitting in a vault. It's not. It's been lent to someone else, who deposited it in their bank, which lent it to someone else, who deposited it in their bank. The same dollar exists in multiple places simultaneously, not physically, but on ledgers, as a credit, as a promise. This is called money creation in economics textbooks, but it's more honest to call it what Amsterdam discovered. It's creating belief in money that doesn't exist. And it works brilliantly most of the time. The system allows for credit expansion that fuels economic growth. It makes capital available for investment. It enables modern commerce at scales that will be impossible with full reserve banking. But it also means the entire financial system is fundamentally built on trust rather than substance, on promises rather than metal, on the assumption that most people won't ask for their money back at the same time. Which brings us to a question that haunts finance. What happens when that assumption breaks? Bank runs, financial panics, systemic collapses. The 2008 financial crisis was, at its core, an Amsterdam moment. Not because banks ran out of gold, but because everyone simultaneously realized that the assets backing the system, mortgage-backed securities, credit derivatives, complex financial instruments, weren't worth what the ledgers claimed. It was the same revelation. The vault was empty. The promises were hollow. The difference is that in 2008, governments and central banks could flood the system with liquidity. They could create new money. They could guarantee deposits. They could prevent the revelation from destroying the entire structure. Amsterdam had no such tools. When the illusion broke, it simply broke. But modern finance has learned to maintain the illusion through any crisis, not by keeping the vaults full, but by ensuring no one ever successfully checks. The Bank of Amsterdam operated for 186 years on a promise it kept for perhaps 70 of them. For more than a century, the world's most trusted institution was a carefully managed fiction. And during that entire time, it functioned perfectly. Trade flowed, commerce prospered, trust remained absolute. The illusion worked better than reality ever could have. This reveals something uncomfortable about the nature of money itself. It doesn't need to be real to work. It only needs to be believed. Gold sitting in a vault doing nothing has value because we agree it does. But paper representing gold that isn't there also has value for exactly the same reason. As long as everyone believes, the underlying reality becomes irrelevant. Amsterdam proved that confidence can be worth more than metal, that trust can outperform substance, that a beautiful lie can sustain civilization better than an expensive truth. But it also proved the darker corollary, that confidence, once broken, reveals the emperor has no clothes. When the vault was opened in 1795, nothing material had changed. The same credit system that worked the day before still functioned the same way. The only difference was knowledge. People knew, and knowledge destroyed what ignorance had sustained. This is the central fragility of fractional reserve banking. It's not that the system can't work. It demonstrably does work, and has for centuries. It's that it can only work in the dark. Shine too much light on how money is created. Show people that their deposits don't really exist, that the bank has lent out their money 10 times over, that the currency is backed by promises rather than substance, and the system can't survive scrutiny. This is why banking has always been wrapped in complexity, jargon, and secrecy. Not because bankers are inherently deceptive, but because the system itself cannot bear being fully understood. Modern fractional reserve banking operates on the same principle Amsterdam discovered. Give people receipts for gold you don't have, and as long as they don't all ask for it back simultaneously, everyone profits. We are all living in Amsterdam's vault. We carry around paper and digital credits that represent metal that isn't there. We trust institutions that promise to pay us money they've already lent to others. We participate in a system built on the assumption that we won't all ask for our money simultaneously. And it works, until it doesn't. The lesson of Amsterdam isn't that fractional reserves are evil or that banking is a scam. The lesson is subtler and more disturbing. Sometimes a lie is more useful than the truth. Sometimes trust is worth more than substance. Sometimes a system built on confidence can outperform a system built on reality, but only until someone opens a vault. For 186 years, no one opened the vault. And during that time, the Bank of Amsterdam enabled global trade, standardized international commerce, and laid the foundation for modern finance. Then someone opened the vault, and the illusion shattered. But by then, it had already taught the world what it needed to know, that the greatest trick in finance isn't creating money, it's creating belief. The Bank of Amsterdam promised absolute security and delivered magnificent fiction. And for nearly 2 centuries, the fiction worked better than reality ever could have. Today, every bank operates on the same principle. Every currency functions on the same trust. Every financial system depends on the same unspoken agreement. Don't all ask for your money at once. We inherited Amsterdam as vault. We just learned not to look inside. If you understand that everything you were taught about money was a simplification or a lie, then you're ready to see deeper. Subscribe to continue descending. Each story peels back another layer of the system we inherited. Like this, if the vault metaphor hit differently than you expected. Comment your thoughts on fractional reserves. Can a system built on illusion be moral if it works? Share this with someone who still believes their bank account represents money that exists. Some truths are worth the discomfort. The spiral continues. And those who see the architecture can choose whether to inhabit it or understand it. The Bank of Amsterdam taught us that trust can be worth more than gold. But it also taught us that trust once broken, reveals that the goal was never there.